Thank you, and thank you for having me. As you said, very interesting times, unprecedented in many ways, and the response that we are seeing from central banks and governments around the world is been swift, but also unprecedented. And where we end up is quite difficult to forecast, but we do know that Kiwis and human beings are rather innovative, and we will find our way through this. And I think, this time next year we'll be in a much better world, but we've got quite a bit to get through in the meantime. So I'm going to try and share a few charts with you. Does everyone see leaves?
Yeah, that's good, Jarrod. Yeah.
Cool. Okay, excellent. As an economist, we do a lot of wargaming in our profession, and we're asked to come up with what we think is happening, and that's one thing. But then we're always asked to come up with scenarios around our forecasts. And right now, well, basically for quite some time, actually, the central forecasts have given us a guide as to where we think things are going, but then the scenarios have actually told us a lot more. And obviously the scenarios that we've been looking at have been on the downside, and the scenario analysis that we're doing now is just getting deeper and deeper and deeper. And we've even been imposed a downside scenario from Treasury, which looks something like what we saw in the Great Depression. So things have obviously evolved in a way where we're looking at worst case type scenarios, and then we're thinking about how we can get out of these out of this situation. And in all the meetings that I've been through in my career, basically when we start wargaming situations like this, the best levers to pull are actually fiscal levers, not monetary levers. So monetary policy can do something. It can help. It can get interest rates low. It can put a bit of cash into people's pockets. It can help. But if you actually want to address this type of situation, you really need a fiscal response, which is much more targeted than a broad-based monetary response. And the go-to lever has always been infrastructure spending. So if you're losing jobs in some parts of the economy, you basically give people a spade and tell them to start digging, and we'll build a few roads, we'll fix a few bridges, and we'll deal with some of those sorts of issues while we can. And that's what we're starting to see the government move to now, which is good. And they've got there very quickly. So as an economist, this is kind of how we feel at the moment. We knew we were running off a cliff, and we were calling for a recession, a little while ago. But now that we're looking down, well, it feels like the fall that we're about to have is much, much deeper. So just to sort of put a bit of a timeline on it, it was only a month or so ago we thought this is just going to be a trade disruption delivered by China, and we were all looking at the global supply chains and how China is the global manufacturer and thinking, oh, this is going to be quite a bad disruption because the global manufacturer has basically shut down due to this virus. And that caused us to say, well, bang, there's a recession for New Zealand. They're our largest trading partner, and they're also the largest trading partner of Australia, who's our second largest trading partner, and we'll get a double hit there. And what that means is basically global industrial production will fall. Now, I drew this chart 3 weeks ago, and industrial production, so the output of the world, I thought bang, we're going to get quite a sharp contraction just on the fact that China alone was closed down. And there's an obvious correlation between global growth or global output and equity markets. So I was kind of banging the drum a little bit about how equity markets had not reacted to the outbreak in China, and that they obviously will in time as the numbers come through. But that wasn't really what happened. What happened was, if you look at the world, you see how many people China have in it, you see how many people India have, and then you look at the rest of the world, you think, well, gee, there's a large concentration of people there. And compared to history, they are traveling more and more than ever before. So there's a chance that this might spread. And of course, as you all know, it did. But you look at this chart where it has spread, and you look at this chart where the population is, and they don't really match up too well. So what we're saying is that we trust the data in Europe and the US, and we know the US has been quite slow to test. The data we're getting out of Asia is rubbish. So the China data has been capped because the leader has said that it's capped. We're not getting much out of India yet because they're not testing, but clearly the Asia, where most of the population is going to see a huge outbreak, whether it's recorded or not. And Africa obviously will be, far behind, even if they do start testing. So this global pandemic is really quite interesting. We've got 1 million people who have the virus or have had the virus, but I think most serious forecasters would say it's a heck of a lot more than that. So what do we do in this situation? Well, you all know that we're trying to do what they call flatten the curve. We could do nothing, let the virus run through, and our healthcare system would basically fall over, and 70% of us, they say, would get the virus, and anywhere between 1% and 3% of us would die from it. It would be short, it would be sharp, it would be over in a year or so, but obviously not a very good outcome. Whereas what we're trying to do is around this blue bubble here. We're desperately trying to prolong the spread of the virus. So even if we get to 70% of us that eventually end up with it, it would be much better if that happened over 2 years rather than 6 months, and everyone manages to get the healthcare needed, and more people will die, but at least they'll die in a healthcare system that's looking after them, and there will be far fewer deaths as a percentage in that blue scenario compared to the red. So what do? We're locking things down. Now, our cases is following an awfully familiar projection than what most other countries have experienced, and that is we started off with hardly any, and then we had a few more, and all of a sudden we're climbing quite rapidly up this log scale towards 100,000 and potentially even as high as 1 million. So the efforts of the government to lock us down is to try and slow this down. But in locking down an economy, it's a incredibly disruptive thing to do. Here's this chart here. We've put on the responses of the central bank and the government, and I think it's important because both of them were a little late, in my opinion, to start with, but they've come to the party and they've come hard in the last 2 weeks. So we had a central bank who made a mistake in their monetary policy statement in February. We all knew there was a COVID-19 outbreak. We all knew that it was in China at that point, but starting to go into South Korea and then Italy. And they upgraded their forecasts. They upgraded their central track as to where the cash rate will be. Wrong footing markets, lifting interest rates, and they stuffed up basically. Then caused a lot of other houses, banks, to change their call and call for no more rate cuts in this cycle, and that 1% was the bottom. I just think that was a bad time to make such a bold call, and we actually left our rate cut in, but we were wrong. You see, we were only calling for one rate cut. We got 3 in one go, and that move from 1% down to just 0.25 is a emergency style cut, but it's one where you've taken it down to the lowest level that you're willing to go as a central bank right now. So academically, they have said that they're quite happy to go down to minus 35 basis points, so negative rates. But the banks have turned around and said, well, that's just going to stuff us completely, and it's going to stuff our systems. And do you realize the sort of pain that you're going to inflict on the savers in this economy? And most of those are in that older age bracket, you know, the boomers, the ones that made all the bloody money to start with. Their savings will get hurt if that was to happen. So what we've got now is a 25 basis point floor, so to speak. Now, what happened from there? Well, that wasn't enough. They came out and saw how the markets, financial markets, were struggling to trade, and there was a lot of liquidity problems in global markets, and it looked like there may come a time when banks would come under pressure. So what they did is they gave us a TAF, what does that stand for again? Term asset funding facility, where we can repo some of our bank bills and RMBS with them for cash immediately should we need it. And they also importantly opened up a swap line with the US Fed so that we can get hold of US dollars should we need it. Now, these two things blew up in the financial crisis of 2008. So bank bills blew up. We couldn't trade with each other. We didn't trust each other. This time around, that is not the case. A lot of banks have exposure to the US, and when things like this happen, the demand for US dollars goes through the roof. So the Fed swap line was quite important, pulling that in. And then probably the most important thing that the RBNZ has done to date, not last Monday, but the Monday before, was announce large-scale asset purchases of 30 billion over 12 months. So being accountants, I know you've just done that in your head and you've gone, oh, that's about whatever it is, 700, 750 a week. Well, what they're doing is they're actually buying 1.3 to 1.5 billion a week. They're front-loading the purchases of government bonds, because the Govy bond curve in New Zealand, it started to melt 2 weeks ago. So what we saw is the US Treasury bond curve, so the largest bond market in the world, the most liquid bond market in the world, started to freeze up 2 weeks ago, which is absolutely extraordinary. So the Fed came out and said, we will buy unlimited amounts of government bonds if we need to. RBNZ is basically copying the Fed's playbook and came out here and said, well, we will buy 30 billion of government bonds. Now, what does that mean? Well, we've got 75 on issue. So they are willing to buy 40% of total outstanding government debt. The important number there is 40%, not 30 billion. because the government bond market is going to increase. They've already announced an extra, I think it's 12 billion in the next 3 or 4 months, and then probably another 12 billion next year. So we could see a government bond market here of 100 billion reasonably quickly. What that means is that the RBNZ's 30 can become 40, and they will just keep buying until they've got 40% of total outstanding bonds. Important point there is that the RBNZ has backstopped the government bond market. And this is important for those orange lines. Now, the government has come out and they initially offered a 12.1 billion package. They've thrown some money into an airline that would have failed otherwise, and they've come up with the big business finance guarantee scheme and a few other bits and pieces along the way. Wage subsidies as well as a big part of that, but also some changes to depreciation and other ways to try and get some cash out to the corporates. Now, those responses there are very large, and we're getting up to around 8.5% of GDP as a fiscal response. I would expect that to go through 10%, possibly towards 15% by the time we're finished with this. That is exactly what we want to see. Now, I have been very, very impressed with both the RBNZ, Treasury, and Grant Robinson's communication with economists like myself. We're on a weekly phone call with both the government and RBNZ separately, but we're on weekly phone calls with them. They're on weekly, sometimes daily phone calls with our CEOs in the banks and other parts, the risk part of banks. And we are telling them what we are seeing, and we are saying, this is what we need, this is what we need, and we're actually getting what we're asking for, which I think is fantastic. Now, this is all taking place in a matter of days. We're part of Parliament. These guys and girls struggle to get these sorts of things done over years. So the speed at which they're moving is fantastic. And I think the size of the responses, even though they ultimately won't be large enough, they're large enough to let people know they're not mucking about. That 6.25 billion for business is a serious number. I think it'll end up being more like 15, but doesn't matter. That's a serious number to get us kickstarted. And obviously the level of support they're doing via the wage subsidy schemes is also very, very important. So the wage subsidy scheme, from my perspective, is all about trying to keep employees linked to employers, and that job still there when we come out of the lockdown and start to eventually go back to something a little bit more normal. That's a key point of protecting the individual, but the one that I like the best is that business finance guarantee scheme, where if you're a business, and I'm sure you know the details probably better than I do, but if you're a business, turning over between 250 and 80 mil a year, you can get access to a loan of up to 500,000, I believe, and you've got 3 years to pay that back. As soon as they announced that, I rang them up and said, you've given us 1 year funding, you haven't given us 3 year funding, sort it out. And they did. Amazingly, a week later, they have given us a 3 year term lending facility. So what that means is that we can go to the central bank and get funding, dirt cheap funding, like real dirt cheap, like cash rate of 25 basis points plus 45 basis points or something like that. And then we need to look at that and go, okay, so that covers that 80% risk that's on the loan, but the 20% risk that we have to wear, we'll put something on top of that, maybe another 10, 15, 20 basis points, whatever that works out to be. And businesses who are in trouble, who are liquidity problem right now because their revenues have dropped to zero, will get a loan of up to $500,000 at a dirt cheap rate of probably 1%, and they'll get 3 years to pay it off. Now, the risk sharing part of this was the bit that we fought the hardest for, and what that means is 80% of those loans are effectively guaranteed by the Crown balance sheet, and that's better than having 80% of those loans guaranteed by our balance sheet. And the reason for that is we would charge a lot more for that loan if we are having to finance it with our depositors, with much higher cost of funding, whereas the government's cost of funding is 25 basis points pretty much, or like maybe 30 basis points over a 3-year period. That to me is as close to a silver bullet as you get. What I don't like about it is that the kick-in level is 250,000 a year. I do believe, and you'll be able to tell me, there are a lot of good companies out there that are probably bringing in 100 to 250,000 a year that are going to get wiped out unless they get some sort of assistance like this. So I'm now currently with others really sort of banging the table on getting that 250k lowered, and I don't quite understand their reasoning as to why they're reluctant to do it. Something around the wage subsidies, but I don't get it, and I don't care. It needs to be lowered. So that's been our response to date, and it's been a good one, but it's not enough. More will have to come. Something else I wanted to say. Oh, okay. So on the functioning of financial markets, so you've got the government's fiscal stuff is very much geared towards the business and the individual, and that's exactly what they should be doing. And we might even go down the path of them, focusing on certain industries more than others. But I think that'll be a mixture of both government and banks sorting that out. But the bigger problem that's developing here, and one which I'm banging the table at the moment, is that the central bank has told us they're going to put $30 billion into the government bond market, but they've forgotten about the semi-government bond market, and that's your Auckland councils and the other councils that get their funding through the LGFA. And LGFA bonds have blown out, and what I mean by that is there's no one willing to buy, but there are plenty of people willing to sell. And when there are more sellers than buyers in bonds, the interest rate goes higher. So they've gone from trading around 30 basis points over governments, which is probably where they should be, to 70, 80, 90 basis points over. And they're trying to tap the market right now. They literally tapped it on Wednesday rather awkwardly, and they're trying to tap it next week. And you've got the government coming out saying, hey, we want to do more infrastructure spending. Hey, we want to boost this economy, but you haven't actually allowed the councils to access debt markets. So that's the next thing, and I would be very surprised if the RBNZ hasn't done something next week. We're attacking them from all different angles to get that sorted out. Now, it doesn't stop there. The corporate bond market in New Zealand is pretty much dysfunctional as we speak. There are some very good companies in this country. You know them all, like the Fonterras and the like. Their bonds not trading so well. If they want to access bond market, do whatever it is they want to do, they will struggle. So the next thing the RBNZ needs to do after shoring up the councils is to come into the corporate bond market and start buying some of their debt as well. They have made it pretty clear that they want to be the bank, the central bank that provides liquidity to crucial markets like the bond markets. And what that means is they've just got to get in there and put a bid in, just we will buy at this level, and it can be an outrageous level. It can be a level that they can make money on, but it will provide an enormous amount of confidence in a very sort of stretched and illiquid market at the moment. And they won't have to do a lot. I mean, LGFA's only got about 11 billion outstanding, and Auckland, what have they got? They got about 8 bill outstanding. So you'd only need to spend about probably 5 billion to shore up that market there. And you can do what the Fed has done in the US and actually go out there and start buying some corporate bonds to try and settle that market down. Because if they don't, these markets will freeze, and these companies will be put under significant stress. For those of you who want to play a home game, you can go and have a look at Sky TV, and see how their bonds are trading at the moment. They're basically being priced for default in the stressed market, and some of that I would argue is legit. Sky TV has not performed very well. It's getting slaughtered by Netflix, but that could be one of the first defaults through a bond market here. Now, getting back to the economics of how we're seeing this, based on a 4 to 6 week lockdown and then a very gradual return. So, going from level 4 to level 3 to level 2 to something else. We believe we will see a 12% drop in economic activity in the quarter that we're now in Q2, and that will follow what was probably a small contraction in the first quarter. So there's your recession, and a 12% drop in one quarter is very, very big, and that'll take our annual growth, how we look from the end of this year compared to the end of last year, down around 5%, and that's pretty big for an economy. But then there's the downside scenario, the one where Treasury is asking banks and economists like me to stress test things, and that is the light green sort of W looking outcome there. What that is a lockdown of 3 months or something in between, where we come out of lockdown but end up back in lockdown. We come out of lockdown a lot later, but people are still very nervous. Some stores open, some stores don't, and the impact on unemployment is a lot more savage, and the impact on incomes is a lot more savage. The number of defaults that we go through is a lot worse, and it takes us quite a long time to get out of this. Now, that particular scenario sees a 30% contraction in one quarter, and it can see our annual growth rates matching what we saw in the Great Depression over a few years, but this is compressed into a very short time in terms of economics, to around 17% fall for this year, and that really would be devastating, for lack of a better word. Now, so when you throw in this sort of GDP figure, the models start spitting out some really ugly stuff, and you start seeing unemployment rates doing what we haven't seen since the Great Depression, basically. So you start seeing unemployment rates spiking towards 14-15% under that downside scenario. The last peak we had, I think, in the early 90s was around 10%. So it's starting to get worse than that, and worse than we've seen in a lot of our other downturns. So our current central scenario, which was our downside scenario 2 weeks ago, has the unemployment rate getting towards 8%. Now, when you stress test a bank, you use the unemployment rate, and it's a non-linear, Well, it actually looks a lot like the bloody coronavirus, to be honest. When you put in the unemployment rate going from 4 to 5, yeah, not a big deal. 5 to 6, things start to creep up a little bit. 6 to 7, don't like the look of this anymore. And then you go 7 to 8, and it starts to look like that kind of exponential lift in defaults, which we get concerned about as banks. And of course, when you're seeing that, the housing market is reacting in a similar way. Now, the adverse downside miserable scenario has us going up very, very sharply to that sort of 14-15% type level and lingering at a very, very high rate for quite a long time. And that world is one where you've got a lot more defaults, you've got a lot more hardship, and you're really wiping out a few industries here and there. Now, what that does for the housing market, one of the best correlators with house prices are demand and supply dynamics, but the triggers for falls is that spike in unemployment. So under those two scenarios, we see house prices falling probably 9% on our central, but then something which I don't think has been charted properly here. We actually have a downside scenario which goes into the 20s. So you're sort of -20, -25% for a housing market. And if you can imagine what that would look like across a stock of housing, it's not good. What we're thinking about from here is, these are literally just sort of simulated ideas, thinking about how a lockdown is impacting certain industries over others, and how things may open up into next year. A lot of guesswork around what will the retail industry look like. We do believe the human element hasn't changed. We do still want to walk around and have have a look, but maybe the percentages of which we do things change. Maybe we move to a world where online is where we do most things. And what does that do? Well, I think that just speeds up what was already happening in retail and entertainment. The tourism sector is the one that I worry about. Farming's fine. Farming's absolutely fine. They're still going. They are being there as the essential service, and that's our bread and butter, so to speak. But tourism's one that worries me, where you've got a lot of really good companies who are making a lot of money five days ago, and in a year's time, I just don't see the tourists flooding back like you would hope. So I feel that there will be some damage to what is the jewel in our crown, I think, as an economy. But I also think there will be a lot of good that comes from something like this. SARS, believe it or not, in Asia taught a lot of countries to walk around with masks and treat each other with a bit more respect. We'll get a bit more of that here. And I think the way that we come out of this, we'll be working from home a lot more. Industries will change for the better, faster. But it'll be an interesting journey. So I'll stop there and I'll grab some questions.